Welcome to this video on swing trading, the market profile trading indicator. What we're going to look at here today is a rather popular technique called market profile, but the way that I use it is a little different than the classic way. The classic approach is to use 30-minute increments, and I am using 30-minute bars here, but they don't really normally use bars. They use what's called TPOs, and that stands for time price opportunity, and that's certainly a fine way, a legitimate way to use it, but I've just decided to simplify things. So of market profile, I take two things and two things only, and that is the value area high and the value area low. And that's what these magenta lines are here. So this is the value area high, and that's the value area low. Now, what are those lines? What those lines are is they tell you where 70% of trades took place the previous day. So you'll notice that the lines are actually the same 2 days in a row. So this day, 70% of the trades occurred between these two lines. And you can kind of see that these 2 days pretty much were the same. The price range was essentially very, very close to the same. So what we have here, what this tells us and how we can use this in our trading, is the concept of expansion contraction. So similar to, well, Bollinger Bands, triangles, wedges, things that are contracting patterns, this is another type of contracting low volatility signal. So we get a low volatility signal for 2 days. Well, what do we expect after low volatility? There's actually a cycle between low volatility that then turns into high volatility. So we're looking for a breakout of this range. And what's cool, if you looked at the high of those 2 days, it would be here. But if you look at the value area high, it comes in much lower, and you could potentially get in earlier into a trade than if you break out or if you trade the breakout of the previous day's high. So that's one of the advantages, is it can actually get you earlier in a new trade. And then it just draws these very clear lines, very horizontal lines that can create nice patterns for you. So as you can see, this boom, bada bing, bada boom. Yep. We go from low volatility to high volatility. And of course, the benefit of that from a practical point of view is that high volatility markets have the potential to make us big money fast. That's fun to see the P&L go green really, really fast. So that's why I like to trade these low volatility to high volatility cycles. So now, other than looking for expansion contraction patterns, another one is for trends. So here is a pattern for trending. By the way, I'm showing you for swing trading holding 2-3 days. You can also use these levels on day trading if you'd like, but I really prefer, well, I use it on all my charts actually, so it's really great. Oh, I should mention here too, if you're wondering where to get these levels, you really need to talk to your software provider and see if they offer them. So this is a trend. Now look at how clearly this marks a trend. It's just a different way of well, mapping it on your charts, I guess is a good term, but it's very clear. So again, I call this the stair step pattern. So go up 1, there's the next step, 2, there's the next one, and 3. And so you can kind of think of this almost as a 5-wave pattern, if you will. I'm going to try to draw some lines here. So that would be 1, and that would be 2 down here. Okay, actually, if you want to draw it on this, you could just draw it 1, 2, 3, 4, 5, draw it on the actual lines themselves. And the bars are going to come in at a little different places, obviously, because the horizontal lines only update once a day. They just stay the same place all day long. Although there are some variations of this that do update intraday. I haven't used that. I just prefer to use this traditional approach. So you can just see a nice stair step pattern, and it takes out some of the noise that could otherwise shake you out. And 5 waves is about average. That's about normal. So if you get 5 waves, you're doing good. So it can go more, of course. It can go less, but I find that 5 is about average and a good place to take some money. Let's actually, we can just stay here on this slide, see where it goes. And yeah, she goes down. Okay, so there you go. Same thing, but now we go into a downtrend. So I show the opposite of this. And we've got basically the same pattern, but now upside down. I kind of like to show things both from a bullish and bearish perspective. So here we go. So there's your 1, and there's your 2. Actually, 1, 2, 3, 4, and then goes down just a little bit for 5. Now, the market goes down way beyond that. But of course, the reason is because this value area low is measuring from this day, the previous day. And if you notice too, this is very significant, so pay attention to this one. This retrace here, in fact, let me redraw this. I don't want to get too messy here. I want to be as clear as possible. So as we go down, okay, make impulse move down, and we barely retrace. So that's a very good bearish continuation pattern. We don't like retraces to be too steep. We don't want a lot of buying come into the market. Another strong impulse move down, and now we just go straight across again. That's good because it means there's not a lot of bullish buying coming in against our downtrend trade. Another impulse move down. Now we get a different type of retrace. This one is not as favorable. We don't like this one as much because it comes up to the lower line, which is the value area low, but it also goes up to the value area high. So you might be wondering, does this thing have to stay below the value area low during the entire trend? Preferably, yes. That makes trading so much easier. However, remember that this zone between the value area high and low is a neutral zone. And so therefore, it really hasn't gone into bullish territory yet. It would have to get above the value area high. So this retrace is still acceptable, just makes it a little tougher if you want to keep tight stops. But from a technical point of view, yeah, it is still a bearish trend. And if you could psychologically stay in there through that, then you're golden because it does actually go down and make another low. So again, 1, 2, 3, 4, 5. And that's going to be really your optimal point to exit and take some profits. Now, if you like this video, understand that of course it's free, but if you got value from it, then that means you should pay that value forward. And the best thing you can do is do it literally by clicking on the share button and sharing it with other people. That's the best thing you can do. Now, if you're watching this on YouTube, go ahead and click the thumbs up icon and leave comments. I love to get your comments. They really encourage me to continue to create more free lessons for you. And I got something very special. It's actually one of my favorite trade strategies. I call it the rubber band trade. It has a very high win-loss ratio. I take this trade every time it sets up. It's simple. I'll teach it to in about 26 short minutes, and you can get that rubber band trade strategy absolutely free by clicking on the image in the top right corner of this video or also in the description below the video. And if you're not watching on YouTube, if this has been embedded somewhere else, then there's probably a link below or an opt-in form on the side. Once you do any of those, I will personally email the video to you with the rubber band trade strategy.